Here is what I've learned after 14 years of trading. The most emotionally and complicated aspect of trading is knowing how to set up take profit and stop loss orders, period. Two traders can use the same strategy, entering at the same price on a chart, but record different results. Why is that? Because of trade management. If you enter a trade without any kind of exit strategy, you will put yourself in the situation to take premature profits, or worse, to run losses. There are only two ways you can get off of a trade: by taking a loss or by making a profit, and money management is one of the most important aspects of trading, often neglected by a lot of traders and investors. Today I'll show you my two best exit technical indicators that will help you to lock more profits and will reduce the probability of taking a loss. Before we continue, if you are new to my channel, make sure you subscribe, turn on the notifications and leave a like to show your support. So when talking about exit strategies, we use terms like take profit and stop loss orders. Hopefully, during your trading day, you'll encounter more take profit orders than stop losses. That's why, in order for you to limit the risk on a trade, you need an exit plan. The complicated part when it comes to trading or investing is to exit a position when you have a respectable profit, rather than waiting for the market to come back against you and exiting out of fear. The difficulty here is that you will not want to exit a trade when it is in profit and moving in your favor, as it feels like the trade will continue in that direction. The irony is that not exiting the moment the trade is significantly in your favor usually means that you will make an emotional exit, because at some point the trade will come back crashing against your current position. Now, how do you know how to exit a trade when in profit? Here are the best indicators you could use to exit the market. The first indicator, the Chandelier Exit. Chandelier Exit is a volatility-based indicator created to enable a trader to stay in a trade until there is a definite trend reversal. By using the Chandelier Exit indicator, you will be able to avoid early exits and maximize returns. The indicator is created using the average true range values over a given time period. Other than the average true range, the highest high and the lowest low price of an asset over a specific time period is used in the calculation. The default settings for this indicator is 22 because there are 22 trading days in a month. The Chandelier Exit is based on the principle that there exists a high probability of a trend reversal whenever the price of a stock moves against the prevailing trend by a distance equal to 3 times the average volatility. So let's say you took a long position on a stock. By setting the Chandelier Exit 3 average true range values below the period high, the indicator provides a buffer that is 3 times the volatility. A decline strong enough to break this level warns you about your long position. So when the price closes below the Chandelier Exit, you should reevaluate your long position. The opposite applies to short positions. So you are short on a stock and the Chandelier Exit is set 3 average true range values above the period low, providing a volatility-based buffer. An event strong enough to exceed this level is a sign that you might wanna take your profits. But even though it's mostly used for stop losses, the Chandelier Exit can also be used as a trend tool. Sometimes you will see a strong uptrend, but not know where to jump the trade. The Chandelier Exit can be used to define the trend and set as a trailing stop loss. In this example, we see the stock breaking out and starting an extended uptrend. The Chandelier Exit defined this up movement quite well as it followed price action going higher. Also, keep in mind that some stocks are more volatile than others and require a bigger buffer, which means that the multiplier should be increased. This example shows the stock in a clear downtrend for most of the year. A normal Chandelier Exit would have triggered some stops just before the downtrend continued. Notice how the stock moved above the dashed line several times during this downtrend. So when trading more volatile stocks, you should increase the average true range multiplier. In this example, the green chandelier line allows for more volatility by using 5 as the multiplier. The second indicator useful for exiting your trades is the Donchian Channel. This indicator is similar to the Bollinger Bands and analyzes the evolution of the price by plotting the highest high and the lowest low over a specific time interval. The most common settings for tracking the price higher highs and lower lows is the 20 period. Dontchian Channels is a useful indicator for measuring volatility in a market. The volatility measures the rate at which a stock moves. A volatile stock is one that records rapid fluctuations in price, while a non-volatile stock registers moderate price fluctuations. Dontchian channels contract when the volatility is low and expand when volatility increases. During periods of low volatility, Donchian channels are narrow, while during periods of high volatility, Dontchian channels expand drastically. The Dontchian channels are the basis of a popular trading strategy called turtle trading. In essence, the turtle trading strategy is based on a breakout of the upper resistance line or lower support line, as the upper and lower Dontchian channel lines actually represent previous support and resistance lines. A break of those lines generates buy and sell signals. The exit signal is simply a breakout of the channel to the opposite side. This allows to ride the trend for a long period before exiting a trade. So Dontchian channels is also a great trend indicator. When the price action breaks through and closes above the upper Dontchian band, this signals an upward movement and a possible buy signal. When a price action breaks through and closes below the lower Dontchian band, this signals a downward movement and a possible sell signal. This may seem a little confusing if you are familiar with the Bollinger Bands. Many traders assume that a breakout above upper or lower Dontchian channels signals an overbought and oversold area, and the reversal could be on the cards. This assumption is wrong. Trading with Dontchian channels is similar to support and resistance trading. It's simple. If the market momentum is able to surpass Dontchian upper channel, then an uptrend could be developing. Conversely, if the market momentum breaks below the Dontchian lower channel, a new downtrend could be developing. Just like in the case of support and resistance lines, once a support level is broken, becomes a resistance level, and once a resistance line is broken, becomes a support line. So how do you take your profits with Dontchian channels? The original turtle trading strategy used a stop loss of 2 volatility units, which basically equals 2 times the average true range of the last 20 periods if you use the default settings. This gives enough room for the price to move up and down in order not to be stopped out too early during a strong trend. You can place your stop losses by using the lower support line and place your stop loss just below the support for a long position or just below the resistance for a short position. Here's an example of the Dontchian channel breakout with a stop loss level above the upper resistance line and the exit level at the break of the upper channel line. Notice how the Dontchian channel moves with the recent period's highs and lows. We were able to ride the trend until the break of the upper resistance line, which initiated a new uptrend afterwards. Another exit signal can be generated using a touch of the midpoint line of the channel. If we look at the daily chart of this stock, we can see that if you use a 50-day period for the Dontchian channels, using the rules discussed before, long trade if there's a close above the channel with a closing of the trade when touching the midpoint line. We see a couple of trades within the past year. It all depends on your trading risk aversion. If you use the midpoint you will leave some profits on the table more often. When the trends are strong, you'll often witness that the mid-band will be touched by the price during retracements and will act as support or resistance, and the trend will resume. So you have to choose if you want to exit your trade at the lower band or at the middle band. If you got any value from this video, don't forget to subscribe, hit the bell icon and leave us a like to show your support. Until next time.